Welcome to Infographic Instant with Brian Michael. In this episode, we'll be asking what determines law firms and investment banks' competitiveness in obtaining Chinese going out mandates. This infographic comes from a paper which you can see the link to that asks, why do Chinese companies choose advisors that are not based in either the acquirer or target company locations? You will recall from the previous infographics we were talking about a disconnect between the companies themselves and their advisors. If these Chinese companies were acquiring companies in emerging markets or the US and EU, then their advisors could be geographically completely separated from these markets. And what we found in the course of the infographics, if you've been following this series, is that an advisor's competitiveness, both a financial advisor and a legal advisor, their competitiveness depends on the advantages given to them by their local financial law and by differentiation. So advisors, legal advisors, and iBanks, they have several competitive tools, of course. Two of those which we highlight are the use of a rich and complex financial law, which they can use to execute more profitable, more interesting contracts, or they can differentiate by providing services, locations, and other margins of value to clients that maybe the bigger elite advisors don't provide. And what we see in the infographic in front of you is that there is in fact a negative relationship between these competitive factors. In other words, advisors in particular jurisdictions with very favorable financial law will tend to differentiate less, or they'll show themselves as having a less differentiated strategy than advisors in jurisdictions with relatively uninteresting financial law. And again, this is a very loose way of talking. You can see the more formal definitions in the paper. To explain the infographic you see in front of you, we show the two dimensions we talked about in our paper. The first dimension is the complexity of financial law, and that is an indicator, an objective indicator, which looks at over 800 provisions in the banking law of numerous countries around the world, and using a complicated statistical procedure, it maps the similarity of those provisions into a scale between 0 and 1. So countries that have a relatively robust, complicated financial law similar to Germany's or the US's, they will have a score closer to 1, whereas in countries that have a financial law that is very, very dissimilar to this rich, full body of financial law, they will have scores closer to 0. And looking at the differentiation measure, this also comes from a statistical procedure. You could think of it as revealed differentiation, because we've actually looked at the types of transactions that advisors in various jurisdictions engaged in, and we measure the similarity of those transactions. So, for example, if one group of advisors, they were dealing in a specific industry, in a particular country, at a particular time, dealing with mostly state-owned enterprises, then they would represent one group, let's say 1 on the scale. In fact, on our scale, those types of companies do gravitate toward 1. And the other set of advisors that tend to advise companies in emerging market jurisdictions, these are private Chinese companies, maybe from a different time period than the elite advisors, they would be binned or placed in a different area of this differentiation measure and gravitating towards 6, for example. So what we see is the usual splash of dots on a scattergram, but I would like to highlight your attention to two relationships between these dots. The first is the apparent relationship, and that relationship doesn't look particularly interesting, even though we show using multiple regression analysis, basically a complicated statistical process, we showed that there is a negative relationship that's important. I mean, it's really there, not just drawing a line between a bunch of dots. So there really is this negative relationship between how complex an advisor's law is and the extent to which they differentiate. And what we see is that, well, after sorting out all of the other variables, like how rich the country is, the number of deals that these different advisors have undertaken, and so forth, once we remove all that extra information statistically, we see this much stronger relationship as shown by this red line. And so we label this the real relationship, and that shows a very strongly negative dynamic between how complex an advisor's financial law is and the extent to which they differentiate. So we can reasonably confidently conclude that advisors, both legal advisors and financial advisors, they differentiate when their domestic financial law doesn't confer particular competitive advantages to them, which they could naturally use when getting Chinese going out business. This has been another Infographic Instant with Brian Michael.